There's a number that follows you everywhere you go. You can't see it most of the time, but it determines whether you can get an apartment, whether you can get a car, what interest rate you pay on a loan, sometimes even whether you can get a job. That number is your credit score. And today we're going to talk about how much power it actually has and why. Now, the modern credit score was created in 1989 by a company called Fair Isaac Corporation. You know it today as FICO. Before that, lending decisions were made by individual bank managers based on personal judgment, which sounds fairer, but was actually a mess of bias and favoritism. The idea behind a credit score was to make lending more objective. Instead of a bank manager deciding based on whether he liked your face, a mathematical formula would calculate your risk as a borrower. In theory, this is more fair. In practice, however, the formula still reflects a lot of systemic inequalities, but that's a bigger conversation. The point is, this number was invented by a private company, it's calculated by a handful of private credit bureaus, and yet it controls huge parts of your financial life. If you want to build your credit or access better loan options, check out the link in the description. It connects you with financial products that can help you get started without perfect credit. Now, your credit score is based on 5 main factors. Payment history makes up 35% of your score. This is just whether you pay your bills on time. It's the single biggest factor. One missed payment can drop your score by 60 to 80 points. Credit utilization is 30% of your score. The second factor is credit utilization, which makes up 30% of your score. This measures how much of your available credit you're using. If your limit is $10,000 and your balance is $9,000, then your utilization is 90%. Lenders don't like that. Keeping your utilization below 30% is better. Below 10% is ideal. Now, length of credit history accounts for 15% of your score. The older your accounts, the better. This is why closing an old credit card can actually hurt your score even if you don't use it. Then credit mix is 10%. Having different types of credit, cards, installment loans, mortgages, this shows lenders that you can handle various types of debt. New credit inquiries are the last 10%. Every time you apply for new credit, it creates a hard inquiry that can temporarily lower your score. Now, here's the thing about credit scores that surprises most people. It's not just banks that use them. Landlords check them before renting to you. A low score can get you rejected from an apartment even if you have steady income, and you have to pay a non-refundable application fee to find out. Car insurance companies in most states use your credit score to set your premiums. Studies show that people with lower credit scores pay significantly more for car insurance, sometimes hundreds of dollars a year more, even if they've never had an accident. Some employers check credit scores, especially for jobs that involve financial responsibility. A financial mistake from your past can cost you a job in the present. Utility companies sometimes check your credit before starting service. If your score is too low, you might have to pay a deposit just to turn your lights on. If you're trying to find financial products that work for your current credit situation, check out the link in the description. Now, here's one of the cruelest things about the credit system. To build good credit, you need credit. But to get credit, lenders want to see that you already have it. Young people face this constantly. You've never had a credit card. You've never had a loan. So your score is either very low or doesn't exist at all yet. But to get a credit card, you need a credit score. To get a decent interest rate on anything, you need years of history. People who grew up in low-income households often don't have parents who could add them to a credit card as an authorized user. They don't have help navigating the system. They start the race 2 steps behind. Now let's look at what happens when your score drops. When your score falls, the cost of money goes up. Every loan you take out comes with a higher interest rate. Every credit card charges you more. You pay more to borrow the same dollar that someone with a good score borrows for less. This is sometimes called the poverty premium. When you're financially stressed, everything costs you more. And the interest rate difference isn't small. The gap between excellent credit and fair credit on a $30,000 car loan can be $5,000 to $10,000 in total interest paid over the life of the loan. Bad credit is literally expensive. But the good news is that your credit score is not permanent. It changes every month based on your behavior. Pay on time. Set up auto pay for at least the minimum on every account so you never miss a due date. Lower your utilization. Even if you can't pay down your balance by much, ask for a credit limit increase. If your limit goes up and your balance stays the same, your utilization ratio drops, which improves your credit. Also, don't close your old accounts. Even if you don't use that old card, keeping it open helps your average account age. Check your credit report for errors. Mistakes are more common than you think. You're entitled to free reports from all three bureaus at annualcreditreport.com. Dispute anything that looks wrong. And if you need help accessing credit products to get started or rebuild, check the link below. It's a good place to find options that match where you are right now. Your credit score is not your identity, it's just a number. But understanding it is one of the most practical financial moves you can possibly make. If you found this video helpful, please give it a like, subscribe, and share it with somebody else who might benefit from it.